Okay, guys, today we're going to be talking not just about savings accounts, but other interest bearing securities that could be offered through your bank, also other products and services that your banks will offer. But we'll start with the savings account, which is a demand deposit account, just like the checking account is, but it is more restrictive in how easily you can access your money. But as you give up some access to your money, you gain a little bit of income in the form of interest. Now, to withdraw funds, there's no check writing capability against this, so you need to go to a bank and fill out a deposit slip. You can go to an ATM, or you can actually set up a link between your checking and savings and transfer money between the two accounts. Just an added step that reduces a little bit of the liquidity. The pros of the savings account: it does earn some interest. It is also FDIC insured up to 250,000. So if you have a checking account and a savings account at the same bank, then you have $500,000 worth of FDIC insurance on those accounts. Again, that's Federal Deposit Insurance Corporation. Now, once again, we want to link these to the account, to your checking account. That way, it's very easy once you've done your budget. When you know how much can be moved into your savings, you can go ahead and just sweep it from one account into the other. The savings account primarily is to buffer for any emergencies. So we want to make sure that there's a minimum of 3 to 6 months of expenses. Depending on how much your expenses are during the month, could this amount that should be in your savings account could be quite high. So if we use this as an example, if your monthly expenses are $4,000, well, 3 times 4,000 is going to be 12,000. That's the low end of the range. 6 times 4,000 is 24. That's the high end of the range. So if your monthly expenses are higher, you should have a pretty large safety net there in the event that you're out of work and we can't access unemployment or workman's comp or something like that. Okay. Anything over this amount needs to now try to seek a higher rate of return. And that can go into things like certificates of deposit, which we'll learn about, or mutual funds, money market accounts, or the stock market, just to name some of the options. So the cons, they're a little less liquid, not tremendously illiquid, but usually a little bit more of a delay between you and your money. Now, I know you do get paid some level of interest, but right now the interest rates are extraordinarily low and falling. Now, oops, sorry, guys. Oop. All right, I'll fix that. Okay, now computing interest. Now we're not going to be able to get the activity, which would show you the difference between simple interest and compound interest. We don't usually, in the real world, compute simple interest. Suppose if you were borrowing money from a parent, you might just be charged simple interest, but if you're borrowing from a lending institution, it's going to be compound. If you're investing, it's going to be compound as well. Dealing with insurance, that would be compound interest, present value, things like that. So computing simple interest, it's the formula I, interest, the amount you earn for someone else using your money, is equal to principal, this is your initial deposit of money, your initial investment, rate, which is R, and that's always used as a decimal. So 6% is 6 per 100, or 600ths 0.06. And T is always time in years. So if it's not a full year, you would do the part of the year as either a fraction or a decimal. Now, very simple here. If you have $1,000 is invested for 6 months at an interest rate of 6%, the principal is what you invested. That is 1,000. 6 months is half of a year, so 0.5, and the interest rate is 0.06. multiply these together, and you will get $30 at the end of those 6 months. Okay. Normally, I would do this on the board, and we would check. This is 500,000, or excuse me, $500. Simple interest of 5%. How much would you earn by the end of the year? So 5% as a decimal is 0.05 times 500. For 1 year, that will be $25. So you can check that on your own. Now, this is normally the formula we work with. Now, this is a little bit intimidating, but this should be covered for anyone who takes Algebra 2. So this is compound interest formula. It's slightly different. We have A equals P times 1 plus R over N to the N times T power. Okay, so A is going to be the amount of money that will be in the account after T years. Okay, so with the above formula, it told you how much you earned. This is going to say how much will be in your account at the end of that time period. P is still principal, so that's the initial investment is going to go right here in this location. If you have a graphing calculator, I prefer, it's much easier to work with. You can type in the entire thing and just hit enter to calculate the whole thing. All right, R is still your annual rate of interest, but as a decimal. So again, 6% would be 0.06 right here. Now, N is the number of times interest is compounded in a given year. Now, as I scroll down below, I'm going to show you some of the terms that are used, like semi-annual, annual, monthly, quarterly, and that will change this N value both here and here, the denominator and in the exponent. And then T is the number of years on deposit. And that also goes in the exponent and multiplied by the compounding periods. Now, in your Algebra 2 class, you can actually derive the formula, but unfortunately, we don't have the time to do that. So these are the main ones that you're going to see. Okay, so annually means N is going to be 1. You get 1 interest payment at the end of the year. Semi-annually means we get 2 interest payments, 1 every 6 months. So you get about a half a payment, but the payment is a little bit more frequent. Quarterly means we're getting paid every 3 months, 1/4 of what would be a full year payment. And monthly means we're getting 12 payments throughout the year, and they're 1/12 about the size of a normal yearly payment. Now, I said about the size because the second any money enters your account, it increases the principal. So that's a larger principal that's earning this rate of interest. So you're going to see that all things being equal, the higher the number of compounding periods, the higher the amount of money you'll have later on. Now, if here in our first example, this is the only example we're going to look at today. I'd like to look at a couple more of these examples on a Zoom call. That way, if you have some questions, we can address them along the way. So if you have $1,500 is invested for 6 years at a rate of 4.3%, paid semi-annually, all right, how much will be in the account at the end of 6 years? And how much was paid in interest? Okay, so the principal, P, is $1,500. The time, 6 years, so that's going to go in for T in my exponent. All right, the rate is 4.3%, so that's 0.043%. And that's semi-annually, which means we get 2 payments per year. So this interest gets cut in half and then added to 1 before we raise it to the power. And then we're also going to double. Instead of 6 payments, we're going to get 12. So we'll have 12 in the exponent. Now, once you take this and raise it to this power and then multiply it by the 1,500, at the end of those 6 years, we're going to have $1,936.21. Okay, now if you subtract what you initially invested, the $1,500, that means you made $436.21 in interest. Now that looks nice as we started with 1,500, now we ended up with 1936. When we factor in inflation, we may not really have we gained money, but we may not have gained buying power. Okay, and that's for a later lesson. Okay, so now I changed the example above just to say if it paid monthly. Okay, so all things are the same, 1500.043. But now the semi-annually has changed to monthly, and you can see there is a dollar amount difference. It's about $4. Nothing crazy, but the quicker money is returned to you, and then it starts to increase the principal, then that new higher principal starts to earn more and more interest. So you're going to see these two lines diverge if we took this out 30, 40, 50, 60 years. Okay. So all things being equal, we want more compounding periods. But things that really make the biggest difference, of course, the interest rate is going to make a big difference. So the higher the interest rate, the better. Although a higher interest rate usually indicates that you're carrying more risk. Okay. So again, risk versus return. Higher the interest rate, higher the risk. Lower the interest rate, lower the risk. Now, the biggest variable, the one that has the most impact, is time. The longer we have to invest, the longer we give our principal a chance to grow. Okay, I'm going to skip this example for right now. Now, here's some of the other saving options that a bank will offer. Certificates of deposit, we've seen these in stacks. These are time deposit accounts. Okay, so since there's a limit of access to it, you're compensated more with a higher rate of return. But that is, we're taking on risk where our money is trapped for 6 months, a year, 2 years, or 5 years. And if I have to withdraw early, there's a penalty, and it's usually around 10% or so. Now, a money market account is a different alternative. Um, there's still some limit in access to it, but the big barriers are I'm required a minimum balance. It could be $1,000, it could be $5,000. It changes from place to place, so you need to inquire about that. There is some check writing ability against it, but it's very limited, like 1 or 2 checks per month. Now, savings bonds are really not a great investment nowadays. The rates are just so low, but your money is tied up for a long period of time. It's referred to as a discount bond. So we used to get a savings bond that would have $50 written on it, and that meant the person who gave that to you bought it for $25. Over time, it'll eventually mature to the face value on the bond. These were referred to as Series Double E's, and these no longer exist. To save money, the Treasury now just gives you an account instead of a physical bond. But you can access the account and see how much that bond is worth, from when you bought it to when you hopefully cash it in at face value. Okay. Now, IRAs are usually offered at a bank. They're offered also at brokerage accounts, a whole host of places. So you're going to have to do your homework before you open one. But it's an individual retirement arrangement. And this is a tax sheltered account that you deposit into during your working years, hopefully to use on retirement. There's 2 types, traditional and Roth. Now, both of these have income limitations. So if you make over a certain amount, you may not be eligible to deposit. Traditional operates kind of like the 401k did, where if I deposit money into traditional, it lowers my taxable income. So if I made $100,000 in a given year and I deposited $5,000 in traditional IRA, the government would only tax me as if I made $95,000 that year. Okay, so I get a little bit of a tax break for trying to do the right thing. Now, if I make too much money, I may not be eligible for the traditional tax deduction, so I can put into a Roth. Now, what a Roth is I've already paid taxes on it. Okay, so since I've already paid taxes on it, when I retire, I won't have to pay taxes on it later. Now, in a tax deferred account, since I didn't pay taxes on it in my working years, when I withdraw from the account, the traditional is taxable. Since I've already paid on the Roth, the money's already been taxed out of my paycheck. I don't get a tax deduction. when it grows tax-free during my working years, and when I retire from it, I can withdraw from this account and there won't be a tax penalty. Okay, so really, you want to have both. Okay, just in case you have an option where, let's say, I sold my home and I had a big capital gain on it, and I was going to have big tax implications. If I'm going to have a big tax hit on a year, I don't want to withdraw from an account that's going to be taxed. I want to withdraw from the account that hasn't been taxed yet. Excuse me, that's already been taxed. The maximums keep changing from year to year. They're up to about $6,000 per year for either account. And then they have what's called a catch up. If you're depositing when you're 50 or older, you got to really start putting money away. So they allow for a little bit more. Okay. Now, when we meet financial goals, all right, we want to know how much money do you have to save and earn an interest for a particular purpose. We need to know how much time we have with which to do this. Now, those things are kind of easy to figure out, but one of the problems is, what's the interest rate going to be on our savings? And right now, it's really bad. So in order to get a higher rate of interest, we're going to have to take a little bit more risk. But you have to decide how much risk are you willing to take. Now, one of the things that we're going to talk about, the rule of 72, it's not exact, but it gives you a good idea. The rule of 72 states, if you take the number 72 and you take the interest rate as the whole number and just take 72 divided by the interest rate. So in this example, 72 divided by 6 is equal to 12. So that means at 6% interest, it'll take your money 12 years to double. If you're investing at 4%, 72 divided by 4, that's 18 years. So you can see your money's not going to be doubling as fast at the lower interest rate. Now, actually, if you look at a lot of savings account, you're looking at 1% or lower, which means it's going to take you 72 years or longer for your money to double. Okay. Now, other services that banks provide, safety deposit boxes. Now, this is not for storing money. This is for storing, sometimes it might be valuable items, but more the way it's usually used is for legal documents. Okay, we don't want them to go up in a fire. We just don't want to store them in the house. So the deed to a house, the deed to a car, the paperwork for a family business. Okay, a lot of that, stock certificates might be on deposit in a safety deposit bank. Now, these numbers might be a little bit higher now in this area, but depending on where you are and what kind of demand there are for safety deposit boxes, you could be spending anywhere between $35 and $100 or higher per year. Now, if all you have is a checking account, you may want to inquire about overdraft protection if you don't have a lot of money in your account. This protects you against bouncing a check. It's almost like the bank is going to give you a short-term loan and cover the check so that it doesn't bounce, and you pay them back plus a little bit interest. Now, the one good thing about this is you won't get that bounce check fee. It won't affect your credit, like if that check bounces, you were trying to pay a credit card or a car loan or something like that. So it may be worth it here, but there are other things that you can set up once you get a little bit more money. And if you can get a savings account, sometimes you can link those accounts, and anything that would have, if you wrote a check and there's not enough in the checking account, sometimes they will pull money from your savings account to cover the check. So you're gonna have to inquire about that and find out what's the cheapest option, because you do have to pay a little bit for overdraft protection. Now, stop payments. I've only used these a couple of times, but they, cost $30, $35, $40. They could save a big headache. So this is instructing the bank to not honor a check that has been written. Now, it could be because you've lost the check, you don't know where it is, so you can just do a stop payment on that so no one can cash it. Or it could be in the event you hired somebody to do something and they didn't come through, so you stop the payment on the check. Now it's $30. That could save you thousands depending on what the situation was. Okay. Now bank cards are often issued. They can be used like a debit card, used for purchases, cash advance, and deposits, and at the ATM. Okay, getting to the end of it, guys. I'm sorry, this is a long one. All right, money orders. Sometimes personal checks have a bounce risk, and some businesses won't take a personal check from you if you've bounced a check before. So a money order is basically you are buying a check, so the money is definitely there. So money orders are used for smaller bills, like I'm paying my water bill, I'm paying my electric bill, I'm paying my cable bill. Now, anyone will take a money order because it won't bounce. It was paid for in cash. Now, big ticket item, you can't use a money order, so you would use something called a cashier's check. A cashier's check is issued against bank funds, so you're buying a check from the bank with your funds, but the check clears off of your bank's funds, not yours. All right, so you're buying a check from the bank. Check is not now written against bank assets and not deducted from your bank account. Everyone's going to take a cashier's check. There is no risk of it bouncing unless the bank fails. But if the bank fails, then we're in a lot of trouble. All right, so cashier's check are usually like if you were putting a down payment on a house, that's the size check you'd be writing where you need a cashier's check, or a down payment on a car or something big, or buying into a business or something like that. All right. Okay, today, I know it was a long video. The rest of the day, I'd like you to work on putting your outline together. So picking the 8 topics and just finding the resources that you're going to use. You don't have to do a lot any more beyond that. So just pick your 8 topics, find 2 resources for each topic, and that will at least get us started on the final project process.